Nike's swoosh getting deflated at this hour with a percentage loss of about 6 right now, 6%. Gets the dubious distinction of being the worst performer on both the Dow and the S&P, all because of the snafu of the season, supply chain issues sparked by a resurgence of COVID. The sports apparel giant's factories in Vietnam, where half of all its footwear is manufactured, have been shuttered by the government there as it desperately deals with increasing cases of the virus. The 10-week stretch of forced closure has caused mass mayhem, drastically increasing shipping times of Nike Air Jordans, Kai Brids, Air Pegasuses, etc. At least 7 brokerages have cut price targets to as low as $160 after Nike cut its full-year sales forecast. We are looking right now at the fact that inventories will be lean for the next few quarters, and the news is leaving its main German rivals, Adidas and Puma, in the red. We should also mention Deckers Outdoor, Lululemon. Well, Lulu's actually flat at the moment, but you got Deckers down 8.5%. Adidas down 3%. What about the retail partners waiting on the inventory? Well, Foot Locker, Hibbett Sports, Dick's Sporting Goods also moving lower. We've got Dick's down 2.5%, well off its lows of the session, by the way. Hibbett Sports down 7.5%, Foot Locker down 7%. It does lead to the question, is Nike the first of what could be a long trail of companies about to stub their earnings toes as they trip over the tangled supply chain? And who might be in the clear? Let's get right to the floor show and our traders. Phil Flynn, I want to start with you. We're less worried about Nike right now. I mean, Nike's at $149. It's still up a decent percentage, about 19% year to date, but year over year rather. But when you see the spillover effect today from Nike's earnings and revenue miss, flag our viewers on who you see being next maybe and where the money flows are exiting and going toward. Give us a sense of what you see.
Well, if you zero in right on Nike, Liz, what you want to look at is a company like VF Corporation, because they have a lot of the same type of brands. They produce, North Face, Timberlands, Dickies, Ulta, Eastpak, very popular brands, but they have issues because they produce a lot of their goods in the same place in Vietnam. So they're going to see the same type of supply chain issues that the other ones are going. But I'm going to take it even a step further because I think this could be a much, much bigger issue. I mean, look at the natural gas shortages that we're having right now in Europe. And you look at natural gas prices here in the United States. That's creating real problems for factories. It's creating problems for fertilizer producers. And I'm really concerned about food companies because they can't get the fertilizer. They're not going to be able to create food. Food prices are going to go up. So if you look at firms like Campbell Soup, ConAgra, Modiza, J&J Snack, Kellogg, Kraft Heinz, all these companies are going to be facing supply chain issues and rising costs because the cost of food and transportation is going to be going through the roof.
Yeah, I like the idea where you triangulate to who also manufactures in Vietnam, which, by the way, Tom Hayes, this was the big message during the Trump administration of go figure out other countries on which you can start building your factories. And everybody fled to Vietnam. And now look what happens. There are complications everywhere.
Yeah. No question, Liz. And you're seeing a number of these companies trading in sympathy on the same weakness. So Under Armour, Crocs, which has been a high flyer, has some manufacturing in Vietnam, Deckers, Skechers, and then the distributors like Foot Locker and Dick's, which you had mentioned. So, they lost 10 weeks of production. Their shipping times have doubled from 40 days to 80 days. However, the demand is there, and that's something that we need to keep in mind because when these exogenous events cause high-quality companies to be misappraised in the short term, it creates opportunities. Now, am I saying to jump in there right now? No, these are going to take probably a week or so to settle out. But by the time the others start taking down their guidance, a lot of that bad news will be priced in, and you may see some of them in coming weeks actually rally on bad news because they'll be down into that announcement based on what happened with the surprise with Nike. So, Nike here is still trading at 30 times next year's earnings on 18% earnings growth. It's a little rich here. I'd wait for lower levels before we get involved. But the big story this week, as you know, was the Fed signaling taper, rates rising the 10-year yield from 130 bips to 146 bips in about 3 days.
That was crazy.
So that's an environment where the value trade and the cyclicals trade starts to outperform again like we saw last year from November. to March, the largest outperformance of value relative to growth.
Before we dump out of this, because I got to tell you, there's news breaking as we have told you already about Evergrande, and not to mention everything that's happening with the chips in the supply chain. Look at the 1-week charts of the S&P, the Dow, the NASDAQ, just to show what investors have endured. I mean, it has been an incredible ride. Monday and Tuesday, we saw pretty significant sell-offs. Then we saw nice jumps where at one point we had the S&P positive for the week. I don't know if that's still in play, but as we look at some of these pictures here, now it's the NASDAQ that's just flat to slightly lower on the week. But if we were to close right now, we're back up above the flat line. What do you expect for next week?
Well, you remember in Airplane when the guy put out his tie and said, "Boy, I picked the right week to quit sniffing glue." I mean, that's what I feel like after this week on the S&P. It really has been. Listen, I think we're going to see more volatility, but at the end of the day, I don't think you want to fight the Fed. The way that the market came back down, people that were looking for that 10 and 15% correction after the Fed, I think that's a lot less likely. So I think we're more in a buy the brakes mode. But I am concerned about commodity prices starting to get out of control here again. I think, the word is going to be energy crisis and how that's going to impact all of these stocks going forward. We have to keep a close eye on it because, if we get a cold winter, I'm afraid, things could really get out of control, and that's going to impact earnings across the board. So let's pray for a warm winter, because I think these rising natural gas prices and energy prices really could impact earnings, pretty quickly.
Well, the skiers who are watching right now are praying for a cold winter. So let's be fair and balanced here, Phil. Phil, Tom, great to see you. Thank you both.
Mountains only.
Folks, it is the case that could decide